Hello and welcome back. Thank you for joining. I would like to make a quick announcement first. I will be changing things up a bit here on my channel because I want to share more content with you and I want to make sure that it is diverse and that it is interactive. So on those days when I don't upload a video, like yesterday for example, you will find an update from me over on my Substack. I'm starting to really love Substack. There's no censorship, as you know, and I can write a post, I can upload a video directly to Substack, I can do an audio podcast, something I'm very interested in, I can do a poll, all of those things and more. Also, I will upload more content to my Rumble channel that may or may not appear on YouTube. And I'm sure that many of you understand why. I have not decided yet how I will do it, but if I do upload it on YouTube or a portion of it on YouTube, it will of course have to be as a short clip or a limited version of that video. Again, I appreciate your understanding and I appreciate your flexibility. If you are interested, you can go ahead and join me on Rumble and Substack using the links in the video description below. So there's a lot going on right now, and if you're following the news, you might be just a tiny bit, just a tiny bit overwhelmed. There are many distractions, many events happening. I actually do hope that you're following the news from a variety of sources so that you get a clearer picture of how slowly but surely, and I will have to say this very carefully, slowly but surely, some of the things that we thought were undisputable truth are being taken away, one little bit at a time. So I would like to bring an interesting article to your attention today that you may not have seen or read yet. This is something that I've been covering for months, if not years, bank failures. Yesterday, CNBC published this piece titled "Why Hundreds of U.S. Banks May Be at Risk of Failure, Why the Fed Expects More Bank Failures." This, of course, was published the day of the FOMC meeting, after which Fed Chair Jerome Powell announced that the interest rates would remain unchanged. I wrote all about that on my Substack yesterday, so I don't want to repeat myself, but higher for longer is a nightmare for banks that have been carrying billions of dollars in unrealized losses on their books since the Fed started to hike rates, essentially. Generally speaking, those unrealized losses result from investment portfolios and primarily small to mid-sized banks being heavily invested, or in other words, exposed to commercial real estate loans. As these banks struggle, and some of them likely won't be able to make it, they may be consolidated or bought by larger banks. These failing banks really only have three options at this time. Option one is to raise private capital. Option two involves actively pursuing a merger with the larger banks, which I'm assuming many of them are in the process of doing. And option number three is a bank collapse. Those are the three scenarios. This should not be news for you. I hope it's not, because consolidating banking institutions has been part of the game plan. You know that already. CNBC starts with somewhat of a vague statement. Hundreds of small and regional banks across the United States are feeling stressed. Feeling stress is likely an understatement here. They go on to explain Christopher Wolf, managing director and head of North American banks at Fitch Ratings, says, "You could see some banks either fail or at least, dip below their minimum capital requirements." When he's referring to minimum capital requirements, he's referring to liquidity. He's saying these banks do not have enough liquidity to continue their business. A little over a month ago, Claros Group, a consulting firm, published results of its research, according to which, of about 4,000 US-based banks that they analyzed during the study, nearly 300, or 282 to be exact, have both high levels of commercial real estate exposure and, in addition to that, large unrealized losses from the rate surge, a potentially toxic combo that may force these lenders to raise fresh capital or engage in mergers. So these banks are facing the worst of both worlds, essentially, if you will. Not only are they overexposed to upside down commercial real estate loans that will likely see higher and higher rates of delinquencies in the coming month and will not be refinanced, of course, but also their investment portfolios are billions in the red. So it's just a matter of time. Looking at this data, you can conclude that it is just a matter of time at this point when the next banking crisis will begin. It is just a matter of time. These 282 banks, and likely there are many more, it is safe to say that there are many more that were not part of the research, they are struggling with liquidity. They do not have enough liquidity. To survive, they will likely require capital. Claros Group estimates that these 282 banks hold nearly $900 billion in total assets on their books. Most of the banks deemed to be potentially challenged are community lenders, with less than $10 billion in assets each. Community and regional banks are going to be affected. By now, you're probably thinking, just show me the list of these banks. I want to see the list. I need to make sure that my bank is not one of them. Well, unfortunately, they are refusing to publish that list. Claros declined to name the institutions in its analysis out of fear of inciting deposit runs. They don't want bank runs. They know that naming these banks would trigger a massive banking crisis within hours likely. None of these banks and many more banks that are not part of this secret about to fail bank list, none of them have the liquidity to give you your money back if all of us rush to take out our deposits. Let's quickly chat about FDIC. Do bank regulators know about this? Of course they do. They've known all along. They receive monthly call reports from banks where they see all of the data, all of the underlying data. Call reports are a regulatory requirement that must be submitted by all financial institutions in the United States by a certain date and by a certain time on that date. CNBC writes that according to Claros co-founder Brian Graham, if there were just 10 banks, he says, that were in trouble, they would have all been taken down and dealt with. When we've got hundreds of banks facing these challenges, he says, the regulators have to walk a bit of a tight rope. And part of the process is not letting you know exactly what's going on because they don't want to cause panic. They don't want to cause bank runs. That statement alone should make us very worried, I would think. This is very concerning, of course, very concerning news. Additionally, I would like to remind you that a couple of months ago, I uploaded a video, I had an entire video where I shared a statement that was made by Fed Chair Jerome Powell. He clearly stated that he does expect bank failures in the near future. He said, sure, we're working on it and it might be manageable in certain situations, but there will be bank failures, so prepare. The primary focus here are small to mid-sized lenders with overexposure to commercial real estate and interest-sensitive investments that have been in the red and result in unrealized, truly massive, billions worth in unrealized losses that have been sitting on their books. Give this video a thumbs up, consider sharing it, and make sure that you are subscribed. I'll see you in my next one tomorrow. Have a great rest of your day.